gold had been underpinned by this 5,000 per gram ruble benchmark, which in just 2 weeks of being implemented had achieved its planned objective of strengthening and stabilizing the ruble US dollar exchange rate, the foreign exchange rate.
With regard to gold and silver, 2 weeks in these markets seems like a month or even longer, and your focus has never come off the paper to physical war that's happening even before the Russia conflict. To answer a lot of requests that we're getting here, can you first off just start off by picking up the thread from our last episode 2 weeks ago?
Yeah, Shane, great to be with you and great to be with everybody again. Yeah, you're right, Shane. I mean, in fact, I think we must be number 70 or pretty close to 70 here. I mean, every single episode has actually focused on, through all of the threads, on the progress of this ongoing paper to physical market battle. And ultimately, that's leading into the price reset. Now, it's been a process, but while the blowbacks from the Russian sanctions have accelerated this gold revaluation process significantly, we must not lose sight of the fact that the introduction of Basel III NSFR standards actually already had lit the fuse. And we went through that a lot over the last few months of 2021 and then as we got into January. Now, what is interesting is that US-centric hot money siloed to the COMEX and deliberately excluded from trading the 10 times larger spot gold and delivery markets still haven't realized this reset is actually underway. If they did, they would not continually capitulate their longs into staged insider run stop hunting exercises like we witnessed at each COMEX-centric pit open this week. And that's in particular drawn a lot of questions. So this is long before Russia launched the petro-ruble trade. Basel III had already commenced, really stealthily sucking out the paper market liquidity that the actors in the casino actually rely on to pull their stunts. Now, let's look at what's happening since Russia achieved their objectives of stabilizing the ruble versus the global fiat crosses, which is a major component here. Now, following ongoing meetings with our well-connected liquidity providers, there are some significant developments which I will address regarding fresh bullish gold drivers following Russia's removal of the fixed 5,000 per gram ruble gold floor peg. And in announcing that it would instead buy gold from the commercial banks at a negotiated price. Now, there's been a lot of confusion over this, so let's put that to bed right away. And as we discussed in detail in our last episode, just 2 weeks ago, gold had been underpinned by this 5,000 per gram ruble benchmark, which in just 2 weeks of being implemented had achieved its planned objective of strengthening and stabilizing the ruble US dollar exchange rate, the foreign exchange rate cross, in the face of a slew of fresh, even harsher sanctions. Now, having achieved a full retracement of the ruble exchange rate with the dollar, the Russian central bank was able to value dollar-priced gold based upon a Russia-centric higher physical supply-demand price. Now, the strategic recovery of the ruble against the dollar was achieved by resetting a true global supply-demand gold price, physical. That's directly linked to a Russia-centric view of how hard money was being valued against an increasingly gold-backed fiat ruble. And the ruble is obviously a fiat currency. And also its exchangeability with all the other increasingly debasing fiat currencies. Less so in the ruble when it's being backed by gold. Now, as a part of a coordinated plan, and this was coordinated to integrate gold, silver, and hard asset commodities into the global monetary system, the Russian central bank is actively managing the freshly stabilized ruble foreign exchange cross. So against against all the official narrative that we hear, following, I mean, goodness me, following Biden mislabeling the ruble as ruble, it was no coincidence that the Bank of Russia was, against all the odds, able to cut key interest rates by a large 300 basis points from 20% to 17%. But note the lack of official comment about this ruble recovery. Now, in fact, following this rate cut, the ruble US dollar cross jumped up to highs against the dollar not seen since the 28th of October 2021, and the anticipated official efforts to psyop the paper gold price lower to intervene completely failed. So the ruble high was obviously an overshoot initially, but nevertheless the ruble has now reasserted itself, trading at better levels than when sanctions were actually instigated.
Hey, Andrew, we've had a lot of incoming questions here this week about the paper market volatility. Can you tell us what you think is going on more immediately?
Yeah, Shane, in a nutshell, the recent paper-centric selling, the bid pulling, because these insiders do not want to put themselves, or officials do not want to put themselves in a position they cannot deliver physical into. So it's mostly bid pulling. It telegraphs these deeply offside options bets placed a paradigm shift ago, and that they're coming due actually next week. Now, while this week's pit open and shenanigans, I mean, there is no other word for it, each pit open saw massive selling efforts. While it warned of a paper market scramble to cover off as many short bets as possible, which is really what this is about, this is constrained as to how many casino chips can be rinsed out of the casino punter's hands. But outside of the casino, in the real world, this counterintuitive paper to physical divergence into a rising physical related ruble price ends up strengthening the benchmark of a ruble price benchmark significantly higher than the COMEX-centric paper dilutive price. So specs relying on correlated algos to buy and sell gold futures, silver futures, they just don't get what's happening outside this casino. However, the arbitrageurs will grab every single ounce of Western gold on offer. And these are the very same sovereign buyers. If you remember, we've been reporting these guys turning up at every single PM fix, capitalizing on the paper to physical exchange for physical conduit. Please, we've gone over what that is multiple times, but essentially it is the tool, it is the transition between a COMEX price being transited through this exchange for physical process, which ends up as a spot price in London, which is actually technically NSFR compliant. And we saw this many weeks before the conflict triggered sanctions. So this activity has really significantly stepped up since the petro-ruble trade commenced. So as a reminder, as we outlined in much more detail in our last episode, and please go back if you missed it, Russia offers a 30% discount for oil and gas to friendly countries willing to pay for oil in rubles or with hard money gold.